I've been doing angel investing for a long, long time. Like many of you, I started out as an entrepreneur. I had my own University of Waterloo spin-off company back in the 1970s. We manufactured video display terminals, ended up selling them globally, and then went public on the Toronto Stock Exchange in the early 80s, along with a number of other companies, giving me an opportunity to cash in, get some spare change. And I decided at that time that, being an entrepreneur is very tough. It's very demanding. I think I had some kids at the time, hadn't seen them recently, and thought, well, it's time to spend some time with the family because being an entrepreneur can take its toll on family relations. And so I thought, well, what'll I do now if I don't want to be a full-time entrepreneur? And I decided that the best thing to do would be to be an entrepreneur vicariously. That is, invest and support others that are going down that journey and down that path. So since the early 80s, when I sold my company, that's what I've been doing. Sometimes I'm affiliated with an organization. Most recently, I spent a number of very interesting and productive years with Simon Fraser University. I still do the odd teaching there. And with a number of companies, angel funds, and of course a lot of volunteer stuff like New Ventures. I'm currently chairman of New Ventures BC, as well as running angel networks, being involved with the founding of the Vancouver Enterprise, now Vancouver Entrepreneurs Forum, and many other things. So over the years, I've been involved with hundreds of startups, typically tech startups, usually started by people like you, and I've been involved as a mentor and investor. So I have a lot of scar tissue on the back, a lot of experience that I can share with you about what this is all about, and also hopefully how you can derive some benefit. Just to kick things off, can any of you shout out some local tech success stories that you've heard about recently or that you're aware of? Just shout out some names. BitStew, good one. Slap. Say loud.
Slack.
Slack. Is that, yeah, Slack, yeah, that's kind of a local company, yeah. Who? Pay by phone, sure, yeah, that used to be Verus, right? Yeah, is that the one? Yeah. Any others? Okay, is more? Creo, yeah, that's one of the big ones, yeah. Hootsuite, yeah, good, okay. So when we talk about success, usually we think of it as a company that at least has gotten to the point where it's starting to pay back to its shareholders. There are many different definitions of success, but I kind of like that one myself, and there's many ways that you can accomplish that. You can build a very profitable business and pay cash dividends to your investors, or perhaps you can buy them out. You could also sell out. I believe that buying and selling companies is almost a little bit like buying and selling products. You can build a company with the sole purpose of selling it. And I guess myself and angel investors, we're really in that business. We're in the business of building companies. Those are our products, and we hope that someone will buy them. And that buyer could be a corporate buyer who will take that entity and merge it with their operations. Companies like Google, Amazon, Microsoft are very well known for that, and they typically buy one or two companies per month, and that's how they stay on the leading edge of technology and innovation. And of course, the other way of doing it is, and I think in a way it's still one of my favorite ways of getting liquidity or cashing in, because that's what I did, and that's going public. Going public on a stock exchange like Toronto or New York or NASDAQ, so that anyone, anywhere in the world, can buy your shares and get involved. Others who may be tired and not happy with your performance, gives them an opportunity to sell. But all investors have liquidity and hopefully have made some money along the way. So there are many different ways of achieving this success. Just at the beginning, I want to talk quickly about the E-myth. It's one of the things I learned early on, and the E-myth basically says that many people who think their entrepreneurs are not really entrepreneurs. They're really technicians suffering from an entrepreneurial seizure. And by that, I mean just because you're good at software or hardware development or something along those lines does not mean you're going to be successful building a business with those particular vocational skills. It takes a lot more than that. I kind of am a big fan of the Malcolm Gladwell 10,000 hours. You know, to be really successful, you've got to put that 10,000 hours in. And those of you who've read his book will know what I'm talking about. So when I invest in you as an entrepreneur, I kind of think of it a bit like if I'm going in for open heart surgery with a doctor, say fresh grad from UBC, would I really want to go under the scalpel with a first-time doctor doing open heart surgery on me? I'd probably want at least a senior doctor there, or preferably I'd like the senior doctor to operate on me. Yet on the other hand, we as angel investors will throw money at you when you're starting your business and you have no experience. And that's often why angel investors and other investors lose their money, because that experience component isn't there. And I can assure you that when you look at guys like Richard Branson or these guys here, the Microsoft team, there's always going to be some people in the background that have the experience. There'll be a financial guy like Sean Hodgins, who you heard just before me, who understands finance and can pull financial statements and projections together. There'll be marketing people, there'll be operations people, and so on. So I think it's that experience that's really important. But bottom line is there are just two success factors, and that's people. You see an example of people here. I think they look like people. And capital. So you need two things. That's all you need. You need you, and you need some money. And if you don't have money in your genes, you've got to talk to angels or other sources of capital to give you a shot at building your business. Some of the observations that I'll just share some of these with you. These are things that I've observed over the last 30 to 40 years of doing this. And the good news is for you, if you're good, you'll get funded. Now, a lot of entrepreneurs complain. They say, there's no money out there and no one's listening to me. But if you don't get funded, it usually means that something is missing. And you got to figure out what that is. It could be a team member, or it could be that experience I was talking about earlier. Another thing, startups are getting better each year. There are all these now, especially here in the Lower Mainland, all kinds of accelerators, incubators, mentorship programs. That kind of stuff didn't exist even 10, 20 years ago. So startups are getting better because they're being better prepared, and hopefully programs like this new Ventures BC competition contribute to that. There's also a lot more private money available. There are a lot of people like us in this room, who've built companies and have made some money by building those companies, and who can now reinvest that money in another startup. And just to digress a moment, I think for those of you who might be thinking about a career, doctor, lawyer, whatever, you have to be really, really good to make a lot of money. A top accountant might make $400,000, $500,000 a year, but that's a top accountant. Engineers, I don't know, maybe in this community, $200,000, $250,000. If you want to make millions of dollars, you can be an NHL hockey player, or you can be a musician, a performer, but then you've got to be one of the best. Whereas on the other hand, in business, you can be a millionaire quite easily. All you have to do is build a successful company. And you make the rules in that. It's not like competing in the NHL or competing with others. You make the rules in the game that you play by defining your market. And we'll get to that a little bit more. But there is a lot of capital that's out there looking for an investment opportunity. And we're seeing that capital trickle down to the retail level, where just about anybody can get involved in this game, in this business of investing in startups. You've probably all heard about crowdfunding. There are some platforms across the country now. One of the local ones is FrontFunder, and I encourage you to check that out. A few years ago, that was not possible because of regulations. And I'll talk about that a little bit more later. And I would also, in a sense, caution you a little bit about getting too enamored with venture capitalists, large institutional venture capitalists. They typically invest in later stage companies. Now, more and more, we're seeing them invest in young companies, but they still, by and large, like to invest in later stage companies. So your best bet is probably to talk to angel investors after you've exhausted your personal and family resources. And another observation, you know, most companies, the majority of companies fail. You heard that on that video earlier this morning that Dave Thomas presented. Steve Blank said there was only 1 in 1,000. Well, that might be 1 in 1,000 that become unicorns. And as Dave mentioned, there are a lot of companies that don't become unicorns. They might be very, very highly successful lifestyle companies, and yet they'll be successful. But even those companies, the failure rates are pretty high. So that's just a cautionary note for you. This is a great time to start a company. Prime rate is low, so investors are looking for riskier opportunities so they can make a higher return. Inflation is low, so a stable economy is good, and the economy is growing, greater than 2%, and BC is leading the charge across Canada on that front. Taxes are low. Personal taxes globally relatively low, and for business, they're especially low, and even lower again if you're in BC. R&D costs. Most of you in the tech business will have R&D expenses, and as Sean mentioned, you can get a lot of that back. In fact, he used the number 45%, but the federal government allows you a so-called overhead proxy, which means that for every $100 you spend on doing research, an engineer, a scientist, or a technician, you can get back $68 on that 100 by allowing for overheads. That's a pretty good deal. And you don't have to compete for that. Her Majesty the Queen makes that available to you just by filling out some forms. And I think the number is getting close to somewhere between $3 and $4 billion a year is invested by the federal government in that SR&ED program. So you should definitely take advantage of it. And of course here in BC especially, and in Canada, we've got great infrastructure. We've got all kinds of organizations that can help you grow and develop. We've got special incentives. We've got the tax credit program here in British Columbia. And for you, of course, you're only limited by your imagination, and it's like me asking you to make a list of uninvented things. Hopefully that will be a very, very long list. And don't worry, whatever you come up with, someone in the US will buy it, notwithstanding what Donald Trump has been saying lately. And I just heard this morning on CBC driving in that we trade every minute with the United States $1 million of every day. So that's a pretty encouraging number, and we're, of course, the biggest trading partner with BC. Excuse the, with the US, I mean. Excuse the fine print here, but I just took this off of a website earlier today off the government's website. So the BC government is very supportive of tech, and tech employment is now growing. And it's important to note that as a contributor to the economy, it's much greater than what people typically think of British Columbia as being good at. Fishing, mining, forestry. Tech beats all of that, hands down, and in fact contributes about 7% to the province's economic output. So that's pretty impressive. There are, of course, all these incentives, and you heard me mention the SR&EDs. It's interesting when you combine some of these incentives and government programs, you can almost fund your business 100% just from a lot of these programs if you know where to look. And I would mention that the National Research Council now has this service. It's called the NRC Concierge Service, and they will help you figure out where to go to get this funding. I want to just give you a little example here. Here's a company, mad scientist in the picture. His name is Michel Laberge, came out of UBC, quantum physics type of guy, He came to our angel network here in Vancouver in 2002. It was just before Christmas. And he said, I got this great idea about saving the world with fusion power. So we'll make fusion energy, and that'll be clean, and it'll be better than traditional nuclear power, and of course be a lot better than fossil fuels. So all I need is $400,000 to do my prototype, and then if the prototype works, then there's a chance that we can actually make this happen. And as we all know, fusion has been demonstrated to work in nature and in labs, but it hasn't been made to work on a commercial scale yet. Best example of fusion is, of course, what takes place on the surface of the sun. So the challenge is to bring that little bit of activity from the surface of the sun down to Earth and use it to generate gobs of power. So he needed $400,000. So we structured a financial arrangement for him whereby angel investors, and he got about 20 or 30 investors that all put in small amounts. So he ended up with his $400,000. And the deal was that if the project failed and didn't work out, basically investors would get their money back. They might even get 10% more than what they risked, just by using these government programs and stacking them one on top of the other. And this little example is still doable today. None of these things have disappeared. Yet, I don't find a lot of people taking advantage of them. And if you want to learn more about these, then by all means, give me a shout. But today, fast forward to today, General Fusion out in Burnaby has now got quite a massive operation, and they've raised well over $100 million and are inching, and I use that word carefully, inching ever close to commercializing fusion power. But they got their start with investors like you and me. So let's talk a little bit about access to capital. At the top there, there's a little link for you. It's moneylinks.ca, and I put together a website, and I tried to identify different sources of funding that you can tap into, and I broke it down into kind of a rainbow of colors. I've got golden capital, which is the stuff you get from government, free money. It's really your money. You're the taxpayers. It's your cash that's going to the government to create these programs, so use it. So that's golden capital. Then there's green capital, and that's the patient growth type capital that angel investors and venture capitalists provide. And of course, there's debt capital. That's the red ink. That money, it's red ink on your balance sheet because it's money that you borrow from the bank and have an obligation to repay. But take a look at that website. It might give you some ideas, and you might be surprised at what's out there. Now, you should, of course, tap into family, friends, and relatives. And if they're not super wealthy, you'll have to start going further than that. And I would skip over venture capitalists and go to angels. You might think about the junior public markets. And here in Vancouver, I've always maintained that why don't we, in the tech sector, do for technology companies what we've done for resource and exploration companies. You know, this province was built on mining and exploration, and it's, of course, now being eclipsed by tech, but that was a foundation of the province. And back, you know, in the 30s, 40s, 50s, the Vancouver Stock Exchange played a major role in that. And it was really a form of crowdfunding. You know, we think crowdfunding is new, but we've kind of gone full circle. So back then, when we had a stock exchange here in Vancouver, anybody, any of us in this room could speculate anywhere from $100 to many thousands of dollars on startups that were exploring for oil, gas, gold, or whatever. And it worked really, really well. You knew as an investor that 9 out of 10 of those projects would fail, but you knew that one was going to hit oil or gold, and you'd get 100 times your money back. And so if you had 10 or 9 or 10 that give you 0, if you have just one that gives you even 20 or 30 times your money back, you're doing okay. And that was the way things worked. Unfortunately, due to a lot of regulations, that never worked for tech, and it still doesn't quite work. However, there are some tech companies that were bold enough, and you can find out who these are quite easily. There are a number of them who have chosen to go the junior public route. Nowadays, it's done through the Toronto Stock Exchange, through the TSX Venture Exchange, which really was the old Vancouver Stock Exchange. It's this, Toronto bought it and rebranded it and relabeled it and is trying to make a go of it. Now there's another exchange, which a friend of mine, actually an angel investor out of Toronto, started, and it's called the Canadian Stock Exchange. And it's billing itself, branding itself as the exchange for entrepreneurs. And I think that's really clever, and I think that's a very viable option for companies to use in addition to other forms of financing. And we mentioned product crowdfunding, and, or rather equity crowdfunding. And on that note, I just want to mention that you should not overlook other forms of crowdfunding. You know, there's the, now it's equity, but more popular has been crowdfunding for your product. And not only does it let you raise money in advance for your product, it's really like prepaid purchase orders for your product. It also helps you validate the market and know whether you've got something that people ultimately want to buy. So Eric Michigowski here, who was from Vancouver, you know, he started Pebble and was one of the most successful crowdfunding raises, and he managed to get 68,929 people. I'm one of those. And raise over $10 million just like that. It was really kind of cool. So I eventually got my watch that I paid $100 for, and you know, worst case scenario, if he didn't deliver, I'd lose $100, no big deal. But very successful for him, and it validated the market. Now, getting back to regulations, and I would bet that a number of you, I'm not going to embarrass you by asking you, but I would bet that a number of you don't know this. And that is this simple fact, that here in British Columbia, in fact, in Canada and the United States and many other countries, it is illegal for you to sell your shares or any shares in your company to anyone without using a full-blown prospectus, which is a legal document wrapped around a business plan. And it's very onerous to do that, very expensive to do that, and it also implies that you're going public, be it on a small exchange or a large exchange. So the only way you can get around that is to use what the regulators, in this case the BC, British Columbia Securities Commission, call an exemption. And an exemption is an exemption from you having to be both a registered dealer and being forced into issuing a so-called prospectus. And one of those exemptions is the one that angel investors typically use, and it's called the accredited investor exemption. It doesn't mean you've passed a test, it just means that you're accredited by virtue of your wealth or income. In other words, you can afford to lose your money, and that makes you accredited and qualified to speculate on startups. And of course, why do you think that this regulation is in place? And believe me, over the years, it's made life very difficult for people like you. Why do you suppose that we have this?
If it wasn't in place, people would be selling their equity to anyone interested in helping their company grow.
Yes, and so you said, maybe you use the mic. That's right, so far, yes?
So if it wasn't in place, us startup
You could sell your shares to anyone.
Could sell it to anyone, right?
And what's wrong with that? Why shouldn't you be able to sell your shares to anyone who wants to buy them?
Wouldn't they have to be vetted?
Who?
The people getting the equity or the shares.
Yes. Why? Yeah, good point. Yeah, you're getting to it. It comes down to the regulator protecting the public by vetting. And, you know, one of the things that we had when we had the Vancouver Stock Exchange that I talked about moments ago, we had a lot of scams. We had lots of people who would not really go out and explore and look for gold. They just started companies, raised lots of money, and then went on nice vacations with that money. They might have said, oh, we're looking for gold, but there isn't any here, so let's go back home, right? They might do stuff like that and cheat you and me as those speculative investors. And that's what caused these regulators to become so obsessed about regulating. In fact, it was really interesting. Back in the early 90s, there was a big expose by Forbes magazine and by Primetime Television where they came to Vancouver and they talked to a whole bunch of companies, and a lot of them were, in fact, tech startups, and they listened to these stories being pitched, and all of them were fraudulent. All of them were scams to fleece investors. So, of course, this is why these regulators jump in and said, oh, we've got to protect the public. Now, in my humble opinion, I would rather turn this over, especially for startups, to the BC Lotteries Corporation, because that's what we're talking about here. We're not really talking about investing, let's be honest. We're talking about gambling, right? We gamble when I invest in one of your companies, I'm taking a gamble. Now, we try to make sure there's a high degree of integrity there, but even though you're all honest and hardworking, your business can still fail, right? And there's nothing wrong with failure. But rather than keeping people out of the market with all this red tape, why not just let them into the market and do what the BC Lotteries Corporation does? And you know how they regulate gambling? They have a saying, and it's know your limit, play within it, right? So it's just knowing that you might lose all your money, and they warn you up in front. And the irony of all of this is that if you actually do issue a full-blown prospectus, the prospectus has something in it called a red herring, and it has risk factors in it. And if you ever look at one, it's interesting because one of the companies I invested in here in Vancouver just this week is doing a New York IPO, and it's a big one. It's a local company called Zymeworks, and they're doing biopharmaceuticals, a UBC spinoff, and they're raising about $70 million US through an IPO, much like we saw recently with companies like Snapchat and a few others like that in the Valley. So in that prospectus, there's 3 or 4 full pages of reasons why you should not invest in the company. They say, oh, we're raising $75 million, and I encourage you to read the one for Zymeworks. It's pretty interesting. So they say, here's all the reasons why you shouldn't invest. And it's 3 or 4 pages, and when you read that, you think, I'm not going to invest, right? So that's kind of counterproductive in my opinion, and they'd be better off just expanding the red herring where they say, and they do this, but it's smaller print. They say, if you invest in this company, you might lose all of your money. So sign here on the dotted line saying you know what you're doing. And in my humble opinion, that would solve a lot of problems. Anyway, let's get on and talk about what angels are all about. So what's a business angel? First of all, it's a successful entrepreneur. And again, by success, I mean someone that's cashed in and made some money from building a business. It's someone who is willing to give back some of that money, not really give back, but give some of that money, but give back some time to another startup. They are mentors and coaches. They can be very, very valuable to you, not just for the money, but because of connections, and connections are really important, but also because of their experience. They often know what works and what doesn't work, and a lot of that is not stuff you get in a textbook. It's just stuff that you end up through experience, and it's not something that is that obvious in textbooks. And of course, they're accredited investors, and that's the requirement that allows them to invest large amounts without you having to do a full-blown prospectus and become a registered securities dealer. Here's just, I'm not going to try to explain this slide, but I pointed out I just put it up here so that you understand from the angel's perspective, here's what's happening, and here's why people want to be angel investors. And the important number here is the IRR of 20% that I've put up in bold letters. What this means is that, and just to give you the background to this research that was done by Rob Wiltbank in the US, he studied thousands of companies, typically tech companies. And he found that for those angel investors that had big portfolios, i.e. had invested in 30, 40, or 50 companies, for those investors, they had a good chance at making an overall return on their capital over time of 27%. Now that's a pretty good number. If you compare that with the stock market, with real estate, or just about anything else, it's at the top of the list. There's nothing I know of that can give you those kinds of returns. And that's what attracts new young angels. This is what will attract you to become an angel investor after you sell your company for a few $1 million and are trying to figure out what to do with the spare change. It's that kind of return that attracts people. But remember, to get that, angels have to do a lot of deals because they know the failure rates are high. And you can see the blue line, the blue bars, the one on the left shows that the failures well over 50%. And on the far right, that tiny little 3 or 4%, those are the successes that produce the green, the big green bar, the big 10 to 30 times returns. So these are some of the dynamics in the business, and it's good for you to be aware of those, because when angel investors sound like they're being tough or greedy, this is one of the reasons they need to make those kinds of returns in order to have it sustainable. In Canada, we have the National Angel Capital Organization, headquartered in Toronto, which does research on angel activity in Canada. They also, by the way, and I think I've got their website up here somewhere, maybe not on this slide, but another one, they have excellent resource material, lots of good stuff for you to look at, things like term sheets, shareholders agreements, those kinds of things. So they're a good resource. Last year in October, we had the national conference here in Vancouver, and they were here listening to startups like you and with a view to making investments. But these are the numbers in Canada, and it shows on the far right in 2015, for example, the median seed round was around $625,000. So that's kind of the ballpark. Now, some angel rounds are much higher than that. They could be in the millions, but the median is 625, and the average is just over $1 million. It's 1.1 million. So, I mean, if you're looking for 20 or 30 million, you can still do it, but it might be a little tough. On the other hand, smaller amounts, a few $100,000, not that difficult. And the situation is very similar in the US. The numbers are a little bit higher, but they kind of track with what we're doing here in Canada. And being here in Vancouver, you have the opportunity to go just an hour's drive south to places like Bellingham, or a little bit further to Seattle, where they also have angel networks. And quite often, Vancouver companies go and present to those organizations in those cities after they've raised money from local angel investors, which is a good thing to do. So how do you engage with investors, or with angels and other investors? 2 words, really. Compelling. Your pitch, your presentation has to be very compelling, because there are a lot of people competing for investment, and it should be a little bit intriguing. And I say intriguing because at typical angel meetings and forums, you don't have time to get everything out on the table. You only have the time of an infomercial. You just have enough time to get someone interested enough to have a follow-on meeting with you. So you just want to sell a little bit of the sizzle. You don't want to blow your whole story on day one. So make it compelling, and make it intriguing. And in terms of what angels want, I'll tell you what they're looking for. Well, first of all, they like to have a little bit of fun. You know, they're people who have been successful in business, and one of the reasons that I like to invest in startups, and I have to confess, I'm a bit of a sucker for deals, and if you have an interesting story, you know, I'll probably give you the benefit of the doubt. But what I get excited about is learning about a new technology, learning about some new drug therapy, learning about some new way of doing something, anything. You know, that's why I got involved with the Fusion project. It's such a long shot, but it sounded exciting and interesting. So that's one of the things that gets people interested. And of course, could be a big opportunity. Very important, you should be a willing protege. If you only want the investor's money, then you're probably wasting your time. You should be aware that they like to give advice, and they like to see you accept some of that advice. Not necessarily use it, but at least listen to it. One of the big turnoffs to investors is entrepreneurs who think they have all of the answers. I sometimes, when someone's making a pitch, I'll go on Google and I'll Google the subject matter of their pitch. So, oh, do they know about this guy down in Des Moines or this one down in Sacramento? And then in question and answer session, I say, do you know about this company? Oh, no, I haven't really heard about them. But we're not worried about them. You know, we're so good that we're not really threatened by anybody. And so that kind of tells me that, you know, they're not willing to listen, and they just have all of the answers. So that could be a bit of a turnoff. Angels like to use their resources, and that's not just their time, which is the most precious resource, more so than money, by the way, but also their connections and contacts. You know, one of the best things that investors can do for you is to make introductions, introduce you to customers or other investors, or to business people who can help you with specific problems. And most importantly, what investors are looking for are at least 10 to 100 times their investment. They're not looking for 27% on your deal. They're looking for 27% on all deals, which includes the failures, which means they're looking for huge multiples on your deal, right? Not the 27%. And of course, they're looking for entrepreneurs who are intense, have a high degree of integrity, and who do things immediately without delay. One of the worst things you can do as an entrepreneur is to procrastinate. That's for you as an individual. For your company, and I picked this little advice up from Milt Wong, who was a well-known angel investor here in Vancouver, who won Entrepreneur of the Year award through Ernst & Young one year. And in his speech, he mentioned he looks for goodness, you know, what's good about your business. And in a way, you know, this is kind of what we're looking for in the New Ventures competition. What's good about it? What's great? Is it scalable? Is it going to be large? And on the money side, the greed factors are going to make some money for all of us. So that's on the corporate side, but on the individual side, which is where it starts, it's your own personal commitment and integrity that's so important. Oh, and let me just go back there, because that's what angels want. But I want to play you a little sound clip here that I put together, which for me summarizes what angels don't want. Let's see if we can make this work.
So tired, tired of waiting, tired of waiting for you. So tired, tired of waiting, tired of waiting for you. Another one bites the dust. Another one bites the dust. And another one gone, and another one gone. Another one bites the dust. Hey, hey, we're gonna get you too.
I think you get the idea. So it's the waiting time. Takes a long time. You know, I mentioned Zymeworks. I've been in that one 12 years. there's about 30 companies in Vancouver. I've been in them for over 10 years. So for 10 years, you know, as an angel investor, and that's all I do. I do that as far as making money. That's all I do these days. And so, you know, you invest maybe 100,000, and then you wait 10 years to get anything back on that. So you have these long dry spells where you've got no income coming in, which is another reason why you want to have a lot of deals, because then you hope that maybe every year or every 2 years you'll get some payout, and of course that keeps you going. So it's those long wait times that are very frustrating for angel investors. And then while they're waiting, of course, it gets to the failures. You know, I get an email from an entrepreneur and it says, update. I think, oh, is it going to be bad news or good news? And they're always the first emails I open, because I hope they say, we've just got an acquisition offer, or we're going public, or something like that. But most of the time it's either, we need a little bit more money and we're going back to our angels for another 4th or 5th round, or, you know, they're looking for some form of debt because they've exhausted everything. So those are kind of worrisome ones. So, you know, it's kind of nice when you hear in an elevator pitch, and I would encourage you at some point, especially when you present to angels, you've got to have the slide in there that talks about your exit, i.e. how investors will get out. And don't say you're going to be acquired or you're going to go public, because those are the only two choices. Talk exactly about how you're going to get investors out. And if someone's going to buy you, if you're building your business to sell it, you know, who's going to be the buyer? Why should they buy you? And what are they going to pay for it? And figuring out what they're going to pay you is kind of an art, but it's achievable. It's something you can do. So that's something that angels like to hear. On the other hand, if you want to build it to an IPO, like Zymeworks, or another good example in Vancouver is Avigilon, which came through the angel network and is doing quite well on the Toronto Stock Exchange. You know, if you want to build an empire, that's great too. In fact, that's music to an angel investor's ears. If you don't want to just get to the point where Google's going to pay $10 or $15 million for you, you know, that's fine. But if you want to build an empire and build your company by acquiring others instead of being a seller, you know, being a buyer of companies, that's wonderful too. And we like to hear that. But having that in your presentation, and for you guys to know that at the very beginning or near the very beginning, is really, really important. It's also good for you to know. It's also something your spouse probably wants to know, especially when you're working those late nights at the office, as you tell her or him. So what do you give to angels? Well, ownership, right? That's the main thing, and that's number one. And on every investment round, you know, forget valuations and discounted cash flows and all that stuff. You can count on giving up 20 to 30% of your company on each round, regardless of where you are in your development or stage or how much you've raised. That's just kind of a rule of thumb. And it always seems to come down to that. And you can study this as much as you want, but that's the number. 20 to 30% is what you're going to give up. So on one of those seed rounds, where you saw those bar charts earlier, if you're raising $600,000, you're probably going to have to give up 20% of the company for that, maybe as much as 30. So you just have to understand that, and it's a market condition. It's just like housing prices here in Vancouver are so much more than they're in Winnipeg. Well, it's the same thing in the investing business. It's not based on the value of the house. It's based on where you operate, the location, and the industry that you're in. You can also offer participation on your board of directors to angels, and many like to see this. And of course, you have to make the point to them that you stand to make a lot of money. And it's important to try to put it into both multiple terms as well as put it in terms of internal rate of return. So when you talk about 10x, if somebody says to me, hey, I'll give you 10x, if that's 10x in 5 years, that translates to a 58% return. But if it's 10x in 10 years, that's only 26%. Big difference. The other thing that you're going to be faced with is negotiating investment terms with your investor. And we call this a term sheet. And here in Vancouver, we had two guys that worked with the National Angel Organization, Boris Mann and Peter Dorsman, and they worked very, very hard to put together a document which you can find on NACO's website, and it's a new project called Common Docs, Common Documents. And what they have on there is a lot of examples of negotiating terms. And it would make sense for you to take a close look at that when you're at that stage. And in a term sheet, you'll have things like valuation, the amount that you're looking for, legal compliance, rights that you have, rights that the investor has, restrictions, things like reverse vesting was mentioned earlier in one of the previous presentations. I think Sean mentioned it, where investors will say, well, we're putting hard cash into your business, but you've got the other 70% of the company, and you didn't pay big bucks for that 70%. All you're doing is making a commitment to perform and deliver over time. Now, it's interesting because back when I first started angel investing, you know, I was negotiating with the company about what percentage I would get. And they said, well, you should get 10% because our sales in the first year are going to be $1 million. And I said, well, that's great, but I'm going to give you $100,000. There's no dispute about what that is worth. But you're only promising me $1 million in sales in the first year. What if you don't hit that? That means I've been cheated because I went along with your line that I should get 10%. So what we did was we structured an arrangement whereby I said, okay, you give me 15%, and if you achieve your 1 million in the first year, we'll cancel 5%, because then you've delivered and you'll be happy and I'll be happy. So there's things like that that you can do, but in the meantime, we also had these reverse vesting provisions on their shares, so that, for example, and a lot of you are going to be faced with this, where you have not just you, but there's 3 or 4 of you, or 5 or 6 of you in a team, in a company. What happens if you each get, you know, 10, 15% of the company, or whatever you decide, and one of you quits, leaves, says, I'm not an entrepreneur, I want to go sailing on Wednesday nights, this is just not for me, and they bugger off. Now, they've got the shares, and you're still stuck with working for the next 5 or 10 years before you get a big payout, and they're along for the ride. Those so-called sweat equity shares have not really been earned by them. So you want to protect against that, and you want to subject them to reverse vesting, which means that they have to commit, say, 5 years to the business. And if they quit after 1, they only get to keep 1/5 of those founder shares, and the rest have to be returned to Treasury. And there's another good reason for that, is because if they're key to your company, you've got to replace them. Now you can use those shares that they forwarded to attract someone to fill their shoes, unless you raise gazillions of dollars and can hire that kind of talent. So that's what vesting is about, and a lot of these terms are embodied in a shareholders agreement. And I think both on NACO and certainly on my own website, there are some illustrations and examples of shareholders agreements that you might want to think about, especially when you're working with others. If you're going to be a sole proprietor and the only one involved in the business, of course you don't need any of this. You're probably also not going to get any investors. But as soon as there's more than one of you, you should be thinking seriously about these things. And I mentioned there the NACO project. It's on the NACO website under Common Docs. So now you know all about what angels want and how it works. Where do you find them? They're everywhere. It's a global movement. You know, they're in India, Australia, they're in Thunder Bay, Ontario, they're in Sudbury, they're everywhere. Here in Vancouver, they're really easy to find because we've got a nice, thriving metropolitan city and with a lot of wealthy people in it, a lot of accredited investors who can qualify and write those checks. I don't know if I mentioned, I don't think I mentioned it earlier that, you know, the whole population of angel investors, because of those securities regulations, is well under 4%. So across Canada, only about 4% of the population is really that wealthy. In 2012, I believe, Statistics Canada reported that out of all of the income tax returns filed that year, for you to be in the top 1% of Canadian income earners, you had to have an income of only $201,000. So that's one of the accredited tests, which is kind of an interesting number. And it's just coincidental that it happened to be 201, the standard being 200. So kind of interesting. But the caution there is that you're dealing with a relatively small population. Yet, you get this clustering of angels that will come to monthly networking meetings. And here in Vancouver, we do a lot of them. In fact, we have 3 or 4, it seems, every month. So I do 2 of them. First Tuesday of every month, something called VanTech, and you can look it up. Then on the second Tuesday, we go a bit big and we go a bit international, and that's called the Keiretsu Forum, which is Silicon Valley based. So this lets you put your case in front of investors, not just from Vancouver to California, but even globally. And then we have twice a year Angel Forum that Bob Charworth-Musters runs called the Angel Forum. And we have a new angel group called Open Angel. That's just been recently formed, and I think Kirk Harrington mentioned that earlier today. So there's no shortage of opportunities. And then, of course, there's the New Ventures events. All of the New Ventures sessions, especially sessions that involve mentors, have angel investors because often the New Ventures mentors are also accredited investors and active angel investors. So it's pretty easy for you to find them. And Canada-wide, NACO Canada also lists all of the different angel groups. So if you're not from Vancouver or if you move out of Vancouver to other parts, then you can learn about these groups. And one of the things that is being more and more popular is what we call a syndication of deals. So if I negotiate a term sheet with one of your companies, let's say Kirk and David and Sean and I negotiate something with you, and we agree to put $400,000 in, but you need another 200, we can tap into our buddies in Ontario or Alberta, because now that we've invested in your company, they'll say, well, you've got your money in, and you've checked it out, and you like it, and we like you, so we'll put the other 200,000 in. And we see a lot of this, especially at the Keiretsu Forum. Just recently, we've seen as much as $20 million, which is usually where venture capitalists play. We've seen as much as $20 million go into fairly young, early stage companies, all from individual private investors, which is quite a bit different from institutional investors, because keep in mind, one of the big differences between angels and VCs is that as an angel investor, I don't have to report to anybody. Well, no, my wife sometimes wants to know what I'm doing. So I usually bring the entrepreneur home for dinner, and I say, honey, does he check out? And she says, no, he's a jerk, so I don't invest. But if she says it's okay, then I go ahead and invest. So I've done my due diligence on the entrepreneur. So that all works really well. But the VCs, on the other hand, you know, one of the deals I did was with, I negotiated a term sheet with Research in Motion, and it took like 1 day back in 1987 to make a decision. Venture capitalists would typically take 6 to 9 months to make a decision because they're not investing their money. They're investing somebody else's money. So they can't be flippant about that. They can't go by gut feeling or appearances or intuition. They have to have a gazillion documents in their files that show that they really, really checked you out thoroughly before they're going to write a check. Which is another reason why angel investing is much less painful. There's also the emergence of funds. We're seeing more and more angel funds. Here's one that I started back in 2003, and we've invested in over 70 local companies. My colleague Thelza Lee, who helps me run the Vantech, created the Vantech Entrepreneurs Fund, called the E-Fund. And these are both called venture capital corporations, and they're called that because here in British Columbia, when somebody invests in one of these funds, other angels typically, they get a 30% refundable tax credit from the BC government, which it makes it quite easy, in fact, to pool some capital. Because one of the things we're seeing in the whole angel community is it's difficult to build a portfolio of 30 to 40 companies. Remember I said that was a key to getting decent returns? But that's hard to do. But a good way of doing it is to pool your money with others. So 10 or 20 of us could each throw $100,000 into the hat, and then as a group, we could invest that in 20 or 30 companies. And we're seeing more and more of that happening in angel groups everywhere, and it gets around that problem of building a portfolio. So funds are very attractive. They're also a great way for smaller investors to get involved. In fact, in the What If Fund that I run, a lot of the entrepreneurs that I've invested in are in turn investors in the fund. So it doesn't have to be for a big amount of money. I've got investors that have put maybe $10,000 in, and they get the tax credit, so it's $7,000. But they do that because it gives them a chance to see what other entrepreneurs are doing, and it gives them a chance to be part of the investing groups in these other opportunities. A couple of years ago, I wrote this book, which somebody saw something that I had on my website, and they asked me to put this together. It's just a short little kind of 50-page thing, and I think you can still download it from my website. I wrote it because I was hearing so many presentations from from entrepreneurs like you, and after filling my ears for 10 minutes, I really didn't know what they were selling. So I thought, let's write a book for you to describe what you're selling. Sounds simple, but I don't think too many people have read it. Just kidding. So what I cover in this book, and Dave talked a lot about this earlier, is what are you selling, who's going to buy it, and why are they going to buy it, and how are they going to make money? How are you going to make money, that is. And you saw this. Dave had this up as a slide, and in fact, the advantage of coming early and listening to presentations is you can plagiarize them. So here I plagiarized Dave's presentation on the positioning statement for the Apple iPod, and I put it up again just for your edification. And normally I take a lot of time to explain this, but since he already did, that's great, we can be more efficient. But I do want to talk about the other part of the elevator pitch, which I would call the investor pitch. And this is one that you probably haven't heard about, and it's the one that's often missing. So it goes like this. So we, you the company, require a certain amount of money. What are you going to do with the money? So for what? In return for what piece of the action? And what I said earlier, your plan, not your dream, but your plan, is to be acquired by who, in how many years, for how many millions, and what does that mean in terms of a multiple or an IRR. So there's a little example of it. And at our monthly angel meetings, just to keep you on your toes and to keep you honest and exhibiting a high degree of integrity, we play angels BS bingo. So, here's how it works. So, we're all listening to your pitch, right? And we've got our little scorecards. And when one of us in the audience can draw a line, we say, bingo, and you've got to sit down. End of pitch. And what that does is it keeps you from being a hypester, right? It keeps you from talking about fluffy things that have no meaning whatsoever. What meaning is there in a unique value proposition? What does it mean to be first to market? What does it mean to have revenue traction? I mean, these are just fluffy words and they don't mean very much. So what we look for is specifics. You know, we want to see what specifically it is that you've got. Not that you're the best or that you're a world leader or got a global opportunity and all of those things, because everybody says that. We want to know exactly and very specifically what's good about your deal. Let's shift gears a little bit, since we've only gone about half an hour, right, Angie? And I think it's really important to talk about the competition, because those of you who are in it, and even if you're not in it, this is stuff that I think be very helpful to you. So, you know, we often get asked, is it a business plan competition or a business competition? Well, it's really both, because, you know, we want to know when the judges are looking at your proposals, they're interested in the business, they're interested in the opportunity, but it's your business plan and the answers to the questions that explain that business. And we give very simple instructions to the jury. We don't give them anything more than this. We say, you as a member of the jury have to pick the idea or the project or the business that's most likely to be commercially viable. So viability, number one, but with the greatest value. So you might have a business that's very viable, it's a done deal, but is it going to be big? And it's the greed factor that Mel Wong talked about. In other words, will it cash flow? So that's number one, because if your business isn't going to cash flow, it's going to die. So cash flow, number one. And will it scale? So you can cash flow at a modest level, and that may be wonderful, but is it exciting and is it going to get big? So this is a tough job for the judges because they have to make the judgment call. But that's okay, that's why we call them judges. They apply their judgment to that very simple criteria. And scale, you know, we talked about scale. And sure, you know, I like to invest in companies that are going to grow big, but I've invested in restaurants and vineyards and things like that. And they've done very well. They produce good cash flow. They don't have to be a $100 million deal. So what's important for you to understand is when you're talking to investors and others, don't tell them what you think they want to hear. Tell them what you believe. Tell them really what your dream is and hope that someone will buy into your dream. So tell them what you want to do, and there's no right or wrong. There's whether you want to be a smaller, more what I call a lifestyle business or go for broke, that's fine. It's your decision, but you've got to tell your story to the right audience. And it all comes down to P&L, and there's two P&Ls. There's your profit and loss and cash flow. That's what Sean likes to talk about. And what others like to hear is your passion and your leadership, the other P&L. And going back to when we made that first $400,000 investment in Michel Laberge with his crazy fusion idea, he was fanatical. And that's why we invested in his project. He had no P&Ls, by the way. So, new ventures. Specifically, let's talk about what's expected here. So there's the idea. Round one, that was due already. Hopefully you got in on time on that one. Round two, and that's where we are now. That's due in just a couple of weeks, I guess, May the 3rd at 6 p.m. Correct me if I've got the dates wrong, Angie. I think
you're good.
Yeah, so this is round two. We're going to talk a little bit about what you have to put together for these rounds. And then we've got round 3, which is the more detailed venture plan, and that's due on August the 2nd. Now, you know, my first plan, when I had my video display company back in Waterloo days, I went to my Bank of Montreal bank manager, and you can see him there, and that's me standing up. And the bank manager says to me, you know, I needed $50,000 because I had these big orders, and I needed to buy parts to fill these orders, and I didn't have the money to buy the parts. So I thought this would be really easy. I go to the bank and say, I've got orders, give me the money, I'll sell the orders and pay you back. Well, he says to me, show me your business plan. So I said, right, when do you want it? Yeah, next week, sometime is fine. So I went to my partners, and I had 3 partners. We all owned the company 25% each at the time. And I said, guys, what the hell's a business plan? You know, this is in the 70s. We didn't have New Ventures, and we didn't have the Enterprise Forum. We didn't have any of those things. I don't know what a business plan was. He wants to see your financial statements. He wants to see how you're going to cover him with collateral, and he wants to see how you're going to service the debt. Yeah, right. Needless to say, we didn't get any money from the Bank of Montreal. Now, I've changed. You can see I look different. But I don't think the bankers changed much. I think they still look the same. So, is a business plan really necessary? One of the first companies I looked at after my exit was a little hole-in-the-wall company above a 7-Eleven in a strip mall called Research in Motion. And talked to this guy, Mike Lazaridis, and he needed a little bit of money. And he didn't have a business plan because they were just doing consulting in those days. But I liked him. And within the same day, we came up with a term sheet, and I agreed to make an investment. And there was no business plan. So this is another thing with angel investors. Business plan is good, and more angels want it, but there may be certain types of businesses where a detailed plan isn't that useful. And a good example is that fusion company that I mentioned. It'd be very difficult to do cash flow projections on that when the commercialization may not take place for 20 or 30 years out. So it's not always necessary, but here at New Ventures BC, we'd sure like to see you take a shot at it. So business plan, business model. I really enjoyed Kirk's presentation. He talked about the canvas, and that's really a good way to get started. It's a good way to kind of think about your company and to start putting some words on paper. And I've always maintained that a plan, any kind of plan, is better than a forecast. There's nothing I hate worse than an entrepreneur giving me a forecast. It's like the weatherman, and you know how reliable that is. So I don't like the idea of forecasts. I like the idea of plans. The plan shows what you will achieve, and most importantly, how you're going to get there. The New Ventures BC questions challenge you to think about what you're planning to do. And tools such as the business canvas model can help you figure that out. So here are the questions. Here are the questions you got to think about. And these are on the New Ventures website. So for round number 2, which is coming up very soon, there are basically 9 questions that you have to have some pretty good answers for. And those are the 9 questions. In round number 3, it's the same 9 questions, but with a little bit more detail. And we don't want 50 pages of glossy, fancy business plans. We just want somewhere either 6 or 8 pages, as the case may be, where you describe as succinctly as possible what you're up to. We'll just flip through some of these real quickly because we do have a few minutes to do that. The product, you heard a bit about that this morning. You know, what is it? Or if it's a service, describe the service. Don't get into too much details about the technology. And this is where I'm often asked by entrepreneurs, well, you know, should we get investors or others to sign non-disclosure agreements? What if they steal the idea? I can tell you, I don't know any angel investors that are keen on stealing ideas. They're too busy doing angel deals to rather than thinking about stealing your idea and starting all over again. So I wouldn't worry too much about that, but if you are worried about it, talk about it, talk around it. Don't give us the algorithm, don't give us the secret sauce, just talk around it and talk about what it's going to do for the customer. Intellectual property, and someone made a reference to this earlier, maybe it was Sean. It's actually more important than you think, but it doesn't mean patents, right? It could be what's unique about what you're doing. It could be something like, I always remember seeing this video about the success of McDonald's restaurants. And they said, you know, one of the innovations at McDonald's was that French fry scoop and how it measures fairly accurately each time the amount of French fries that go into one of those little envelopes. That's a clever little innovation. And it's things like that that apply to traditional businesses are their intellectual property. One of the companies that I've invested in that I'm quite proud of, and I hope they'll give us an exit very soon, is a local Vancouver company called Dea Foods. And Dea makes a vegan, it started off making a vegan cheese. It's a young fellow on the North Shore that didn't like a lot of the vegan products, especially the vegan cheeses that he found in stores. So he said, oh, I'll invent one, I'll create my own vegan cheese product. And it was so good, it took off, and last year, the company did close to $100 million in sales. And it did that with a couple of $1 million, not a lot, of angel money. No venture capital money, no banks, a few $1 million, and 6 or 7 years later, this year, they'll break over $100 million. No problem. Not only do they have vegan cheese, but they have pizzas with fake pepperoni and all kinds of stuff. You know, salad dressings, yogurts. The sky's the limit. So in their case, the IP is the recipe, you know, the secret, literally the secret sauce. So no patents, but still very valuable. And it is actually that got the investors excited about the company, tasting it and saying, hey, this is great, and you're not going to tell anybody about it, otherwise they'd steal it and copy it. So IP is important. For new ventures, we want to know what stage of technology development you're at. You know, are you still at the idea stage, or maybe you even have customers, and that would be good to know. The status of your business plan. You know, where are you in your business development? And most importantly, what are the missing pieces and what still needs to be figured out? Question 5, on the market. That's probably the most important question, and it gets back to those frickin' customers. Who are they? Where are they? Why are they going to buy your thing over somebody else's thing? And don't ever say that you're unique and you're the first one there, because you probably aren't. It's not ever good to say you don't have competitors, because there's always an existing solution, and you have to talk about why you're better than that existing solution, whatever it is. And what's the potential? Again, Dave talked about the total available market, and as he said, and I'll say it again, don't say you only need 1% of a big market. It's much better to say your market is 100 million and you're going to get 30% of it, and then define that market. And on that note, I would highly recommend reading Regis McKenna's Marketing is Everything. It's in the Harvard Business Review. It's what got Apple to be so successful. McKenna was involved with Apple in the early days, and he was able to get Apple to define its market for personal computers in such a way that they owned their market and were not in the fray with IBM and HP and Dell and everybody else. And so it's a really, really good read, and I would really highly recommend that paper. It's a short read, it's not a book. And go back to Dave's slides. I've put them up here just as a reminder, and this presentation and all the presentations that you're hearing today will, of course, be on the New Ventures website, so the link is there for you to learn more about that. Distribution. How are you going to get to your customers? So a little bit about the channels and the chain from you to the customer is important. As important, I would say, almost as important as customers, are competitors. Because at the end of the day, that's the only thing you really have to worry about. You know, if you didn't have competitors, you could be lazy, you could relax, you wouldn't have to be constantly innovating and developing. But you can bet that someone right now, somewhere, is working on what you're working on. And, you know, I saw the kiss of death for research in motion when Apple came out with its first iPhone. Had a camera in it. And Jim Balzilli, whom I never actually met, I knew Mike quite well, but I didn't know Jim. And Jim was supposed to be the marketing guy, not the technical guy. I remember him being interviewed about the Apple phone, and he said, "Who would want a camera in their phone?" That was, for me, the curtain for RIM. I said, how can you be so dumb as to not realize that even, he said, the reason being, business people, this is a business product. We have business users, and business users aren't out taking photographs. But business people, even if they're not taking pictures of their kids, they're taking pictures of documents and articles and things like that. They're using Scannable to replace scanners with their iPhones and stuff like that. So, you know, competition, he dismissed it. He fluffed it off. He was dismissive of Apple and others. That to me was really one of the turning points for RIM, because they had the market edge. They were the leader. They were, you know, conquering the globe with the BlackBerry, but they forgot to keep their eye on competition. And, you know, you look at companies like Apple, and they compete with themselves, right? They're trying to obsolete their own products before someone else does it. So that's a good takeaway. And, you know, if you do believe there's no competition for whatever you're doing, you should really invent some competition and come up with some, because people won't believe you that there isn't any competition. Very important is your team. Now, not so much yet at the New Ventures competition level, but this certainly will be very important when you're pitching. And it may not be that important at your seed level, but certainly as you grow and are looking for larger amounts, this becomes increasingly important. Because after all, what is a company? A company is a collection of people, and those people have to make something happen. So it's all about the team. And putting a good team together is a real skill, and it's also really good for you to be able to identify what you're missing. Don't be shy about saying, well, we don't have a financial guru, or, you know, we're missing someone with deep knowledge about patents. Don't be shy about saying that. Just identify it, because that gives investors confidence that you see what still needs to be done, as opposed to them pointing it out to you and embarrassing you. And then at the end, it all comes down to money. That's why investors are in this business, because even though they like to have fun and learn about new things, they're not going to be able to continue doing that if it's not sustainable. And that means money, and it means cash flow. So finance comes at the end. You know, after you've figured out what you're doing, who you're selling it to and all of that, how to price it. Pricing is so important. And that's, I really enjoyed Steve's talk on that. I never heard it before, so it was really an eye-opener. But pricing is so important, and it all translates into financial statements, which then translate into cash flow, so that you can figure out how much money you need. And Sean mentioned that, looking back, when you read financial statements, you'll see cash flow statements as part of a financial report. But for you, that's not what we're looking for. What we're looking for is a month-by-month, going out in the future cash flow projection, where each month you basically say, what have I got to spend, what's coming in, and what's my ending bank balance in that month. And on my website, there's a little spreadsheet you can download and play around with. This is ideal for companies that are making stuff, so widgets and things like that. This is really ideal for those kinds of companies. And when you do these cash flow projections, it shows here, for example, that after a number of months, $106,000 is needed based on certain assumptions. And then in the second part, you do a little bit of a what-if analysis or what-if manipulation, and you change some of those basic assumptions, and it turns out that by just tweaking one or two really simple things, you need $700,000 to get this business started. So what are you going to tell angel investors you need? Are you going to ask them for 100 or 700? Both will make this business viable. And this is a business, as you can see from the top line, will generate $2 million in the first year with a healthy net profit margin, which is an attractive scenario to investors. But how much do you really need? So cash flow, very, very important. So we got a few minutes left, so I'm just going to wrap up. Those are the questions. And I just want to wrap up by talking about why do deals, why will you get funded when you talk to investors? It's because you are credible, you have domain knowledge, especially around your market. You're realistic, you are a good planner, you can demonstrate how you can achieve your goals. You're aware not only of what you know, but also what you don't know, and you know when to call on experts to help you out. You're not alone. Investors don't like to invest in lone wolves, they like to invest in teams. You're in control, you have confidence, you have leadership, and you have contingency plans. You have a plan B, plan C, whatever. And mainly though, it's because you're liked. And it really comes down to being a courtship. It's like a marriage. When you get investors in, they're really jumping in bed with you. They're getting married to you. And so, you want to get to know them. You want to get to know one another. And I can tell you of companies that I've passed on just because, I didn't see eye to eye. There was this tension with the entrepreneurs. And I can tell you about others where I've invested in them just on the basis of a first meeting, and only because they came across really, really, really personable, and because I ended up liking them. So a few final tips, and I think this is almost my last slide. So again, for repetition, don't make that 1% of the market claim. It's a big turnoff. Don't compromise yourself by giving investors what they want to hear. Tell them your story. Don't lose out on Angel's BS Bingo. Don't hype too much. Be really down to earth and straightforward in your presentation. Show some leadership. When I look back at all of the companies that have failed, and I can assure you I've had way more failures than successes in my portfolio, and I try to analyze these and understand, why did this company fail versus that one? What does it come down to? And it's nearly always a lack of leadership. If I had to pick one thing, it's not a lack of money, it's not competition, it's not all of those other things. It's always because the person lacked that leadership. And that's so important. And finally, the last word is never procrastinate. I remember Mike Brown, who was involved with Ventures West, big venture capital company here, about 20 some years ago. There was a company that's now public and has had some ups and downs, but seems to be doing okay, called Ballard. and many of you know that company. And Jeff Ballard, who is the founder of Ballard, is no longer with us, unfortunately. But I remember, I think it was back actually in 1987, and you're all too young for this, but in October of 1987, there was a very important event. And Mike Brown phoned Jeff Ballard on a Friday afternoon, and Jeff, like most Vancouver entrepreneurs, was out fishing in the Gulf of Georgia, the Straits of Georgia. And Mike says, look, we got the term sheet signed. $2 million is waiting for you to get your company going. And Jeff said, well, I'll be right there. So he packed up his fishing rod and met downtown here on, I think we're right here on Water Street, as a matter of fact, signed the papers, got the $2 million. You know what happened that weekend? The crash of 1987. And on the Monday morning, the Dow, the S&P, everything was in the toilet. And all the deals that were being negotiated and agreed to the week before were killed. And Ventures West admitted that they would have not gone through with this deal if Jeff had waited until Monday to sign off. So he got his check, and Ventures West got its shares, and Ballard went public, and Ventures West did okay with that deal. In fact, I think they did quite well, and now we have a good local high-tech company in here in BC. And I've seen so many companies fail just because the entrepreneur would put something off that they could do today and not do it today. So that's my last little tidbit, and with that I'll leave you with a couple of websites that I would encourage you to check out. Most importantly, the New Ventures one, where you will get the content of these seminars. Now, I've used up all the time, and I know that I think it's a bar, right?
Yes.
Waiting for us.
I will have
And
instructions
I don't want to
soon.
stand between you and the bar. So unless someone has a really burning question, I would say, come and talk to me one-on-one, and let's start partying.
Okay. Thank you, Mike.
Thank you.